Right now, somewhere in a glass office overlooking a major financial district, there is a massive hedge fund manager freaking out.
Oh, absolutely sweating over a Bloomberg terminal.
Sweating over a screen, frantically buying up cocoa futures contracts. And the crazy thing is, it's all because the surface temperature of the Pacific Ocean got just a few degrees too warm.
Right, which sounds totally disconnected from finance.
Exactly. But because of that algorithmic panic in the commodities market, the package of chocolate cookies you plan to buy at the grocery store tomorrow might just be slightly smaller.
Or cost you an extra 50 cents, yeah.
Right. So welcome to Talk Tickers. Today we are doing a deep dive for retail investors into the official source material from a massive corporate earnings call. We want to show you exactly how global climate anomalies, aggressive Wall Street gambling, and rural logistics networks dictate every single detail of what goes into your grocery cart.
Which really completely shatters the illusion of the grocery store aisle. I mean, you walk in, you see a brightly colored display, and you grab a snack on impulse.
Yeah, it feels like a spontaneous, isolated decision.
But it's not. Behind that single transaction is one of the most complex, fiercely defended logistical and economic machines on the planet.
It's massive.
We are looking at a machine that has to constantly recalibrate itself against inflation, weather disasters, and, honestly, the deeply fractured psychology of today's consumer.
And to map out that machine, we are diving deep into the official transcript of the Q2 2026 earnings call of Mondelez International, ticker symbol MDLZ.
You might not instantly recognize the corporate banner of Mondelez, but I guarantee you have their products sitting in your pantry right now.
Oh, for sure. I mean, they are the global powerhouse steering brands like Oreo, Ritz, Cadbury, Toblerone, and Sour Patch Kids.
The heavy hitters.
Yeah, the absolute heavy hitters. So we have the raw transcript featuring their CEO, Dirk van de Put, their Chief Operating Officer, Luca Zaramella, and their brand new Chief Financial Officer, Amit Venati.
Who, at the time of this recording, has been on the job for exactly 1 month.
Just 1 month. So we get the benefit of fresh eyes auditing a legacy snacking empire. So, as always on Talk Tickers, we are going to hit the headline numbers first, then the story behind those numbers, dive into management guidance, and finally give you the actionable bottom line.
Sounds like a plan.
Okay, let's unpack this, starting with the headline numbers and the sheer scale of the global chessboard they're playing on. What did they report?
Well, the scale is really the only way to understand their underlying financial architecture. For context, in the world of retail investing, the market reacts almost violently to headline numbers, right?
Always.
So Mondelez reported 4.4% organic top-line growth for the quarter. And the crucial part is that this was driven by strong, tangible volume.
Meaning they actually sold more cookies.
Exactly. This wasn't just a case of jacking up prices to create the illusion of growth while selling fewer items. They actually moved more physical product.
And the market reaction makes sense when you see they actually raised their full-year top-line guidance based on that volume. They are now projecting quote, at least plus 2% growth for the year.
Which is a solid signal for investors holding the stock.
Yeah, but digging into the transcript, the truly mind-bending part of this growth story isn't happening in the United States.
No, not at all.
Dirk van de Put spent a massive portion of this call outlining an absolute explosion in their emerging market dominance.
To visualize this, you really have to look past the mature grocery markets of North America or Western Europe. The CEO noted that consumer confidence across their emerging markets is structurally stable and quite strong.
Which is a stark contrast to what we're seeing here at home, which we'll get to in a minute.
Right. He pointed to India as firing on all cylinders, describing the demand there as very strong, alongside highly resilient consumer behavior in Mexico and Brazil.
Now, they did concede that China is currently experiencing a softer period, right?
They did, yeah. But their internal modeling expects that to gradually improve. The real story, however, is how they are physically capturing that demand. It comes down to distribution density.
Okay, I'm still trying to wrap my head around the distribution numbers they casually dropped on this call.
Yeah, they are wild.
Just wild. Mondelez just officially hit 1 million stores in Brazil. 1 million individual physical locations selling their brands.
It's hard to even picture that.
And in India, over a very recent stretch, they added 100,000 completely new stores to their distribution network. I mean, we aren't talking about plugging into a centralized Walmart supply chain here.
No, consider the brutal logistics of pulling that off. Getting temperature-sensitive goods like a chocolate-covered biscuit into 1 million distinct points of sale across a geographically sprawling and infrastructure-challenged country like Brazil is, well, it's an engineering marvel.
You've got melting chocolate on rural dirt roads.
Exactly. You are navigating highly complex interstate tax structures, relying on networks of local wholesalers, and dispatching fleets of small delivery vehicles. Every single one of those 1 million locations requires someone to ensure the product hasn't melted, the display branding is accurate, and the localized price point is competitive.
And the mathematical formula they're using to justify this massive infrastructure build-out in places like India and China is fascinating.
The 50-50 split.
Yes. The CEO broke down their net revenue growth in these specific regions into a strict 50-50 split. Half of it is same-store sales, and half is new doors.
It's a dual-engine growth model. So half of their revenue expansion comes directly from going to a vendor in Mumbai who already sells Cadbury and convincing them to stock more SKUs or, convincing the consumer who walks into that store to buy a premium product instead of a baseline one.
Upselling the existing footprint.
Right. And the other 50% of the growth is entirely reliant on physically laying down the supply chain to reach consumers in secondary or tertiary cities who literally could not purchase an Oreo yesterday.
Which introduces a massive cultural hurdle. I mean, you can't just parachute an American Ritz cracker into a rural market in Mexico or India and expect it to automatically dominate.
No, local taste palettes are different, texture preferences are different, and the domestic competition is deeply entrenched.
So how do they get around that?
This is the core of their global jewels versus local jewels strategy.
I saw that in the transcript. What does that mean for an investor trying to understand their moat?
Well, a global jewel is your standard Oreo. It is universally recognized, highly standardized, and manufactured with incredible economies of scale.
Was the cash cow?
Basically. But Mondelez knows that a global monolith brand can only penetrate a market so deeply. So they deploy local jewels. These are regional brands they have acquired or developed that are deeply woven into the specific cultural fabric of a country.
So they play both sides.
Exactly. By operating both, they execute a pincer movement on the consumer's wallet. The global jewel acts as the aspirational premium tier, while the local jewel captures the everyday high-frequency shopper at a much lower, more accessible price point.
Wait, I need to challenge the strategy for a second.
Go for it.
Because coming from a tech perspective, opening 100,000 stores in India sounds suspiciously like a classic cash-burning land grab.
Right, the Uber model.
Exactly. In Silicon Valley, a company will operate at a massive bleeding loss just to acquire a massive user base, praying they can figure out how to monetize those users 5 years down the road. Tell me Mondelez isn't just throwing billions into an Indian distribution furnace to artificially pump up their top-line volume numbers for Wall Street.
The transcript specifically addresses that exact skepticism, and it comes directly from the newly appointed CFO, Amit Vanati.
The new guy.
The new guy, yeah. But Vanati brings over 3 decades of experience in consumer packaged goods, so he isn't easily fooled by empty volume. He stated that his initial deep dive audit of the company completely validated their thesis. He says this is structural growth, not a cyclical land grab.
Okay, but how does he prove that?
The underlying mechanic here is what they call revenue growth management, or RGM.
Meaning they aren't just subsidizing the snacks to get them on the shelf.
Precisely. They are painstakingly calibrating the package sizes and the pricing architecture for those new markets to ensure the expansion is profitable on a unit basis from day one.
That's a crucial distinction for retail investors to catch.
Definitely. The CEO used a key phrase, pointing out that these categories are still wildly underpenetrated. In mature markets, almost everyone eats a packaged snack daily. But in emerging markets, millions of consumers are just entering the middle class and are only now adopting daily packaged snacking habits.
So Mondelez isn't fighting for a larger slice of a static pie.
No, the pie itself is doubling in size, and they're building the pan to hold it.
I love that analogy. Okay, so emerging markets are essentially this brute force engine of volume expansion. They are building the physical pipes. But if we pivot to the story behind the numbers in North America, the strategy shifts entirely.
Because the pipes are already built.
Right. The pipes are built, but the water flowing through them, the consumer's money, is behaving erratically. Here's where it gets really interesting. As investors, we have to decode what the CEO called the K-shaped consumer.
It requires analyzing how broad macroeconomic inflation translates into deeply personal daily habits. Dirk Van de Putte noted that while consumer confidence in North America has technically rebounded from its absolute bottom, It remains stubbornly subdued.
People are stressed.
Very stressed. Energy prices, housing costs, and the lingering psychological scars of recent inflation are keeping household budgets under immense pressure.
So if you aren't constantly reading economic white papers, think of a K-shaped consumer base like this. The economy is fracturing into two distinct, contradictory realities, pulling apart like the arms of the letter K. On paper, macro purchasing power might be stable, but individual consumers are paralyzed by anxiety over their job security and the cost of living.
And we see that anxiety manifest instantly in the downward arm of the K, which represents an aggressive hunt for absolute value. Consumers are feeling so financially squeezed that they are heavily rationing their discretionary spending.
And how is that showing up in Mondelez's numbers?
Well, because of this, they are reporting high single-digit growth in value channels. We are talking about deep discount grocers and dollar stores, where the shopper's primary filter is simply getting the most calories or volume for the absolute lowest out-of-pocket cost.
But the upward arm of the K is what makes this a psychological puzzle. At the exact same time that people are aggressively hunting for bargains at the dollar store, there is an explosive, persistent demand for premium, better-for-you products.
It's totally counterintuitive.
It is. Mondelez pointed out that their ventures portfolio is thriving. Brands like Perfect Snacks, which sell refrigerated high-protein bars, Give & Go, which dominates premium fresh-baked goods, and Z-Bar, targeting the premium organic kids market.
It exposes a fascinating paradox in modern consumer behavior. I mean, a single shopper will absolutely refuse to pay an extra 50 cents for a generic box of cereal, seeking out the cheapest possible bulk option.
Right.
But that same shopper will then turn around and drop $4 on a single organic gluten-free protein bar.
Why? I mean, why do we do that?
Because the premium snack represents a small, affordable luxury. It's an accessible indulgence or a perceived investment in their personal health, acting as an emotional counterbalance to the anxiety they feel elsewhere in their budget.
Basically, I can't afford a new car, but I can afford a $4 fancy protein bar.
Exactly that.
But I am hung up on the supply chain mechanics of this. From an operational standpoint, how does a singular corporate entity successfully cater to the Dollar General shopper who demands maximum cheap volume, while simultaneously servicing the Whole Foods shopper demanding zero sugar and premium ingredients, without causing absolute chaos on their manufacturing lines?
The mechanism they use to control that chaos is called price pack architecture, or PPA.
PPA. Okay, translate that Wall Street jargon for us.
The CEO highlighted PPA as the primary driver behind their resilient bottom line in North America. They abandoned the idea of selling a universal one-size-fits-all box of crackers a long time ago. Instead, they re-engineered the physical product packaging to match the exact psychological and financial constraints of the specific retail channel.
Let's break down the unit economics of that, because for an investor, this is brilliant. If you are targeting that downward arm of the K-shaped consumer at a value channel, you can't just blindly discount your standard grocery store box.
No, you'd destroy your profit margins instantly.
So what do?
Exactly the opposite. They deploy a smaller, single-serve, or specifically calibrated multi-pack. By shrinking the package size by perhaps just an ounce or two, they can drop the retail price below the critical psychological threshold of, say, $1 or $2.
Oh, wow. So the financially constrained shopper gets a product that fits into their rigid weekly cash budget.
Right.
But Mondelez actually achieves a higher profit margin per ounce than they do on a standard box.
You nailed it. Higher margin per ounce, lower absolute price point, while simultaneously moving giant, high upfront cost variety packs through the warehouse club channels for the upward arm of the K.
But beyond just changing the box sizes, they are radically changing the literal buildings where they sell these products. Dirk Van de Put explained that historically, growth for a snack company was almost effortless in standard traditional grocery store channels.
You just fought for better eye-level shelf space.
Right. But grocery channel growth has stagnated, forcing Mondelez to aggressively hunt for new avenues.
He specifically highlighted their push into convenience stores and away-from-home channels, noting they are achieving mid-single-digit growth in spaces that used to be afterthoughts.
Why were they afterthoughts?
Historically, the margins in these alternative channels were tighter, and the fragmented delivery logistics were a huge headache. So legacy brands simply focused on the massive volume of supermarkets.
The convenience store strategy is a perfect example of why you can't just copy-paste a product line. You would logically assume that a giant brand like Oreo would automatically dominate a gas station convenience mart.
But the CEO pointed out that a traditional sleeve of Oreos is functionally a home consumption product.
Right. When you pull over for gas, you aren't looking to eat 30 cookies in your car. I mean, usually.
Hopefully not. You want a beverage, a single pastry, or a protein bar. So to actually win shelf space in the convenience channel, they had to aggressively pivot their mix toward brands like Cliff Bars and single-serve baked pastries.
They even took direct control of the distribution in certain cities, right? Bypassing third-party brokers to ensure their exact product mix was on the shelf.
They did. But the evolution of their away-from-home channels requires a fundamentally different corporate muscle. We're looking at deep integrations with quick-service restaurants, the massive QSR chains like McDonald's, or building bespoke snack programs for institutional corporate cafeterias.
The logistics of a QSR partnership are completely invisible to the consumer, but wildly complex. I mean, you can't just back a truck up to a McDonald's and drop off a pallet of standard retail cookies.
No, Mondelez has to operate as a B2B business to business co-manufacturer. They have to reformulate their cookie crumbles so they don't dissolve when blended into an industrial soft-serve ice cream machine.
They are deeply embedding their proprietary flavors directly into the restaurant's permanent menu architecture.
Which serves as a brilliant defensive moat against the volatility of the K-shaped consumer.
Because if inflation causes a sudden dip in foot traffic at traditional grocery stores, Mondelez doesn't panic.
Right, because they have these massive embedded QSR partnerships continuously pulling volume through a completely different sector of the economy. And alongside this channel expansion, their ultimate defense mechanism in North America is a relentless cadence of innovation.
They're forcing engagement.
Yeah.
You can't just let a brand sit there on the shelf. You have to give a stressed consumer a novel reason to pick up the package.
They highlighted the momentum driven by new releases like Ritz Drizzled, Sour Patch Kids Chews, and they teased a massive upcoming full-scale relaunch of the core Oreo brand.
They're basically using novelty to break through the economic anxiety.
However, all the price pack architecture and strategic marketing in the world cannot insulate a physical product from the literal realities of the planet. And this is where the earnings call abruptly transitions from a masterclass in consumer psychology into a stark lesson on agricultural vulnerability and climate volatility.
Let's move to management guidance in the future, because shielding consumer demand doesn't matter if your physical supply is melting.
Literally made.
When reviewing their global performance, there was this jarring data point about Europe. Their Q2 performance in the European market actually missed Wall Street's expectations. The culprit: an unprecedented severe heat wave across the continent.
It turns out consumer demand for chocolate evaporates when the product is literally melting on the unair-conditioned shelf.
Or turning to liquid in the shopping bag on the walk home.
It acts as a blunt reminder that a multinational snack conglomerate is, at its foundation, highly dependent on raw agricultural commodities. And no commodity has seen more chaotic, destructive volatility over the last year than cocoa.
The cocoa market has been insane. Luca Zaramella, the chief operating officer, had to spend significant time walking investors through the mechanics of the cocoa market because the price charts have looked more like a volatile cryptocurrency than a stable agricultural crop.
They really have.
I want to dissect the specific jargon Zaramella used, because he was throwing around terms like pop counts, the super El Nino, and a short squeeze executed by specs.
Wall Street loves its jargon.
So let's translate this for our listeners, starting at the absolute source. When Wall Street wants to know if chocolate is going to be expensive next year, how do they actually figure that out? What the heck is a pop count?
A pop count is literal industry shorthand for pod counts. The forecasting of global cocoa supply is surprisingly analog at its root level. Agricultural inspectors and market analysts physically walk through cocoa farms in regions like West Africa and meticulously count the number of developing cocoa pods hanging on the trees.
Wait, they just count them by hand?
Basically, yeah. It is the leading physical indicator of harvest yield. Zaramella noted that current pop counts are trending slightly below the historical average, which immediately triggers alarm bells for commodity traders.
Though he was quick to contextualize that, pointing out that this slightly lower count is actually a normalization. The previous mid-crop, which is the smaller secondary harvest in the annual cocoa cycle, was exceptionally large, so a slight pullback is just the trees recovering.
But you cannot look at pop counts in a vacuum, especially not when the global climate is undergoing a super El Nino event.
Right, the weather anomaly.
This is a severe, prolonged warming of the Pacific Ocean that acts like a domino effect on global weather patterns. For West Africa, which produces the vast majority of the world's cocoa, a super El Niño can mean devastating droughts followed by torrential, unseasonal rains.
Which creates massive physical uncertainty. Manufacturers don't know if the crop will wither on the branch or rot from excess moisture.
But the physical weather is only the match. The financial markets provided the gasoline. This is where we see the physical farm violently collide with algorithmic Wall Street trading.
Zaramella explicitly blamed a portion of the price explosion on a short squeeze driven by specs, which translates to speculators.
To understand how a candy bar becomes a financial weapon, you have to understand the futures market. A futures contract is essentially an agreement to buy or sell a set amount of a commodity at a set price on a specific date in the future.
And companies like Mondelez use these contracts to lock in their costs and hedge against price spikes. That's normal business.
Normal business, yeah. But the market is also flooded with speculators. Hedge funds and algorithmic traders who have absolutely zero interest in ever taking physical delivery of cocoa beans.
They aren't making chocolate.
No. They are purely placing financial bets on the direction of the price.
So visualize it like a massive high-stakes game of musical chairs. But the chairs are physical tons of cocoa.
Yeah.
The speculators looked at the market and took short positions. They were betting that the price of cocoa was going to drop, essentially betting that there would be plenty of chairs available when the music stopped.
Exactly. But then the Super El Niño hits. The pop counts look unstable. Suddenly the market realizes half the chairs are missing.
Panic ensues.
The price of cocoa begins to tick upward. As the price goes up, the speculators who bet against it start losing millions of dollars. Their brokers issue margin calls, demanding they put up more cash to cover their losing bets. To stop the bleeding, these hedge funds are forced to close their short positions.
And the only way to close a short position is to buy the underlying asset.
Which triggers an automated buying frenzy. You have massive financial institutions desperately slamming the buy button on cocoa contracts, not because they want to make chocolate, but just to survive the margin call.
This tidal wave of forced buying artificially rockets the price of cocoa to unprecedented historical highs. That mechanism is the short squeeze.
It creates a scenario where the cost of raw materials for consumer goods is utterly detached from fundamental supply and demand, dictated instead by the unwinding of leveraged financial bets.
Which is terrifying for a retail investor holding Mondelez stock.
Yes, but Zaramella's primary goal on this call was to forcefully reassure investors that despite this terrifying price action, the structural reality of the cocoa market in 2026 is exponentially healthier than the crisis they navigated in 2024.
He brought receipts to back that up, providing some vital data points. He noted that the global market currently possesses a massive physical surplus, specifically 500,000 metric tons of excess cocoa sitting in reserve.
To frame how significant that is, he pointed out that this surplus represents roughly 10% of total global annual demand. That is a massive buffer against a bad harvest.
And he looked at the industry's forward coverage. Currently, the major players have secured 10 months of physical supply coverage.
Compare that to the panic of 2024, when the industry was operating on razor-thin margins with only 7 months of coverage. Furthermore, because of the brutal losses taken during the recent short squeeze, those financial speculators are now holding significantly smaller short positions.
The algorithmic powder keg has been largely diffused, removing the explosive upward pressure on the price.
Exactly.
But seeing how fragile the system is makes me want to ask a very blunt question. If the core defining ingredient of your most lucrative products, chocolate, is entirely at the mercy of chaotic ocean temperatures, regional droughts, and hyper-leveraged hedge funds, tell me how investing in a chocolate company isn't just buying a highly risky, unhedged weather derivative. How can a CEO look Wall Street in the eye and promise stable, compounding returns when they have literally zero control over the rain and Ivory Coast?
That underlying anxiety is exactly what analysts were pushing management on, particularly regarding their financial outlook for the year 2027. And the executive response was essentially, we agree, which is why we are aggressively engineering our way out of that dependency.
They're pulling two massive strategic levers to insulate their 2027 earnings from agricultural chaos.
The first lever is ruthless operational efficiency. They outlined a plan to drive elevated productivity throughout their supply chain, specifically targeting Europe and the US to squeeze out any remaining waste.
And they explicitly cited artificial intelligence as a tool to drive down corporate overhead. AI has evolved past a marketing buzzword and is now a literal deployable mechanism for automating back-office finance and logistics, directly protecting the profit margin.
But the second lever is the existential shift. Zaramella explicitly stated their objective is to drive portfolio solutions that are, quote, less cocoa reliant.
That's a huge pivot.
They are actively, deliberately pivoting the monolithic identity of the company. They want to decouple their future growth from the volatility of the cocoa pod.
Which means pivoting the corporate weight toward products anchored by much more stable, predictable commodities like wheat and sugar. We are talking about baked goods, biscuits, and pastries.
And that strategic pivot perfectly sets the stage for the most fascinating part of this earnings call: the mechanics of their innovation engine and the billion-dollar master plan surrounding a caramelized biscuit called Biscoff.
To appreciate the scale of what they're doing with Biscoff, you first have to understand the intense pressure Mondelez puts on its own R&D pipeline. Innovation for a company of this size isn't just a test kitchen coming up with a wacky summer flavor.
No, it is a strictly enforced financial mandate. Dirk Van de Put revealed their internal benchmark. The company demands that 10% to 15% of their total global net revenue must be generated by products that were launched within the last 3 years.
When you stop to run the math on a multi-billion-dollar conglomerate, demanding that up to 15% of your total revenue comes from products that literally did not exist 36 months ago is a staggering requirement.
You cannot coast on the legacy of the classic Oreo. You have to constantly execute what the CEO termed breakthrough innovation, layered on top of constant renovation. Tweaking the price pack architecture, rolling out seasonal packaging, and introducing limited edition flavors.
And right now, their absolute biggest bet in the breakthrough innovation category isn't a proprietary recipe they spent years developing in a secret lab. It is a massive, highly structured licensing collaboration with Lotus Bakeries to weaponize the Biscoff brand.
Weaponize is a good word for it. The CEO was not shy about the financial projections here, stating on the record that they expect this specific collaboration to eventually generate between $500 million and $1 billion in revenue.
$1 billion in structural growth derived entirely from partnering on a specific spiced biscuit flavor profile. When you look at how they are executing this, it breaks down into 4 distinct, highly calculated layers. It is a masterclass in squeezing every drop of value out of an intellectual property asset.
So it's layer 1.
Layer 1 is immediate integration, merging Biscoff into their existing dominant chocolate lines.
They are injecting the Biscoff flavor profile into their massive global chocolate infrastructure. This means launching premium chocolate tablets filled with Biscoff cream, embedding Biscoff cookie pieces into the chocolate matrix, and creating new textural experiences.
And the consumer response data is explosive. When they debuted this hybrid chocolate range in Scandinavia, it instantly seized a 7% market share in its very first month.
Capturing 7% of a highly mature, heavily defended European chocolate market in 30 days is almost statistically impossible.
Even crazier, when they launched the Biscoff chocolate line in Australia, it didn't just cannibalize existing sales. The CEO noted it single-handedly drove 3% growth for the entire Australian chocolate category. It expanded the total addressable market.
Which logically progresses to layer 2, where Mondelez transitions from a flavor partner to a massive industrial manufacturer.
Using those emerging market pipes they built.
Exactly. They are leveraging their unmatched global distribution, remember, those 1 million new stores in Brazil and the rapid expansion in India, to physically manufacture and distribute the standalone Biscoff biscuit in emerging markets.
Because Lotus Bakeries has engineered a phenomenal, globally beloved product, but they simply do not possess the capital or the logistical footprint to build factories and secure shelf space in rural India. Mondelez does.
And the pent-up demand in these emerging markets was instantly validated. The CEO detailed how they spun up a dedicated Biscoff manufacturing line in India, and the entire production capacity sold out in the first month.
That's insane.
They are already scrambling to bring a second manufacturing line online just to keep up, and they are preparing to launch the standalone biscuit in Brazil early next year.
Then you look at layer 3, which is a strategic expansion into an entirely different temperature state in grocery aisle. Ice cream.
They have co-developed a dedicated range of Biscoff ice cream products that Mondelez will push through its global distribution channels, capturing the consumer in the frozen food sector.
And finally, layer 4, which is the cross-pollination phase. This is the part of the transcript that reads like fan fiction for snack enthusiasts.
Oh, absolutely.
While they haven't officially launched these SKUs yet, the CEO was openly teasing the R&D pipeline. They are looking at taking their massively popular 7 Days packaged croissant brand and injecting it with Biscoff cream. Or the holy grail of snack crossovers, engineering an Oreo cookie where the classic vanilla center is entirely replaced by Biscoff spread.
If you zoom out and look at this from a macro corporate strategy perspective, the brilliance of the Lotus partnership is risk mitigation. Developing a brand new proprietary flavor profile from scratch is incredibly expensive, and the failure rate with consumers is terrifyingly high.
But by licensing Biscoff, Mondelez completely bypasses the risk of consumer rejection. The flavor profile is already globally validated.
The demand is a known quantity. Mondelez simply has to plug that established IP into its world-class manufacturing and distribution logistics. They are trading R&D risk for execution risk, and execution is what they do best.
But even with a guaranteed hit like Biscoff, a product doesn't sell itself. You still have to engineer the cultural awareness. You still have to make sure the consumer knows the Biscoff Oreo exists before they walk into the grocery store.
This relies heavily on their advertising and consumer spending, what the transcript refers to as A and C. They noted a double-digit increase in A and C reinvestment for the quarter.
The critical detail here isn't just the amount of money they're spending, but the mechanics of how they're deploying it. COO Luca Zaramella stressed a massive operational shift away from non-working media.
In the legacy era of consumer goods, companies would burn tens of millions of dollars on non-working media. Think exorbitant production budgets for massive television commercials or broad, untargeted billboard campaigns that hit millions of people who have zero interest in buying a cookie.
Now, they are relentlessly focused on working media, which is hyper-targeted, highly efficient digital spend.
And this is where artificial intelligence enters the chat as a revenue-generating tool, not just an overhead reduction tool. They're explicitly deploying AI algorithms to optimize their creative media and targeting.
Instead of a blanket advertising strategy, they are using AI to parse massive data sets and identify hyper-specific consumer cohorts.
The algorithm can determine precisely which demographic, in which specific zip code, scrolling on which specific platform, is most statistically likely to purchase a premium gluten-free snack bar versus which cohort is most likely to impulse buy a Biscoff chocolate tablet.
The AI then tailors the ad creative and serves it directly to them. This level of precision targeting makes the launch of these billion-dollar innovations incredibly capital efficient.
It is a completely different paradigm of corporate marketing.
Okay, so as we pull all of these complex logistical, financial, and agricultural threads together, it's time for the bottom line. What is the ultimate takeaway from this 2026 snapshot of Mondelez for our retail investors?
The overriding narrative of this transcript is a masterclass in corporate engineering. You're looking at a management team that absolutely refuses to be a passive victim of global macroeconomic trends. When they face a headwind, they don't just complain to Wall Street. They actively build a machine to bypass it.
Whether they are laying down physical infrastructure to capture volume in India, deploying granular price pack architecture to squeeze margins out of the financially anxious K-shaped consumer in the US, or executing massive licensing deals like Biscoff to circumvent R&D risk.
They are systematically pulling every available lever, and most crucially, they are acknowledging the physical threat of climate volatility on cocoa and actively steering the entire massive ship toward a less vulnerable wheat and sugar-based portfolio.
It fundamentally changes how you view the physical world around you.
Yeah.
The next time you grab a quick snack at a rural gas station or pick up a precisely sized package of cookies at a dollar store or order a co-branded dessert at a fast food drive-thru, you aren't just making a random spontaneous choice.
You are actively participating as the final node in a highly calculated, meticulously engineered global supply chain strategy.
You are the final conversion point in a network that connects a sweating cocoa farmer counting pods in West Africa to a frantic hedge fund manager covering a short squeeze in Chicago. to an AI data center optimizing advertising algorithms, all the way to a delivery driver navigating the streets of Brazil.
It's incredible to visualize.
It really is. And it leaves me with one final, slightly provocative thought for you to mull over as we wrap up this deep dive. We've explored their aggressive adoption of artificial intelligence for hyper-targeted marketing and back-office efficiency.
Right.
We've also dissected their explicit, urgent strategy to engineer less cocoa-reliant products as a direct defense against severe climate change and commodity volatility. So if you aggressively project those two converging forces into the future, what does the snack of the next decade actually look like?
Oh, that's a wild thought.
Are we rapidly heading toward a reality where our favorite treats are entirely formulated by artificial intelligence, literally engineered at a molecular level in a lab to perfectly simulate the taste, melt, and texture of climate-threatened ingredients like cocoa, all while being dynamically priced by an algorithm to match our hyper-localized, K-shaped budget constraints?
Will the Oreo you buy in 2036 even resemble agricultural food as we know it? Or will it be a total triumph of AI-driven, climate-resistant synthetic engineering?
That is a deeply fascinating question, and given the accelerating pace of climate anomalies and AI capabilities, it is a question the entire global food supply chain is going to have to answer much sooner than we think.
Definitely.
Something to chew on the next time you're staring down the overwhelming options in the snack aisle. Thank you so much for joining us on Talk Tickers as we unpack this massive global operation. Keep questioning the everyday products around you, keep looking behind the curtain of the supply chain, and we'll catch you on the next deep dive.